It's quarter to 3 right now. Welcome to next episode of Blockrevision. So we are getting bored and really tired with this inflation that is going on throughout our economy times. Right now we are perceiving even tiny change with a cheerfulness. That's why circumstances, as we know, alter cases. We are cheerful watching at CPIs dropping to 8.5%, whereas back in March we were really frightened with those circumstances. But is it just the name of the game where we are not really recovering because we are still lagging behind where we should be right now? Is it just the ECB and the Bank of Japan that are doing a good job of making the Fed look credible? Today I will discover more cases regarding this topic. That's why I invite you for another dose of news regarding whether it's stocks, indexes, commodities or crypto. So let's get started. So let's get to economy view, and right here you will find it. At first, US wages are right now stacked around 5.2%. These wages in other environment would be incredible, but right now regarding recent environment, we may find it with the CPI, even if looking a bit pickish. Recently, after a recent gauge been published, we are still far from the situation where we may admit it as a normal. Heading next, there is still some aspects that may push us to think that there is still much to be done in order to bring back this normality, if we may say that, that has been 3 years ago, before the pandemic. Right now, if we just take a look at a monthly look at average rent price trends across the United States, everywhere it seems like it's growing, nearly everywhere in the most cases, and taken as average right now, this trend is nowhere near from stopping, and that's why we may find that the cost of living for the US, even with this food prices been maybe stopping out in the months to come, we are still far from that we may admit it that it's already over. So also we have a bit more bitter news to come. That's the second consecutive 10-year auction which, just like inflation, has seen yields top and right now is sliding into as fast as a US economy that is heading for a recession. Right now the outcome is that this 10-year yields are finding to get far lower from here as the curve inverts to even more levels. So that means that we are still expecting the bad times not got over yet. That's why we still need some very cautious reaction in order to those outcomes that right now are delivered by the economy. So we can expect that Fed should lower the pace of hiking interest rates, but for now there is still just a projection. Evans from Fed recently said that I expect that we will be increasing rates the rest of the year and into next year to make sure inflation gets back to our 2% objective. That's why it's not definitely a time to celebrate. Right here we can find that interest rate hike supposed to get further, even if we have losing some momentum on on those jurisdictions such as China, that is getting a little bit more flattening related to whether it's United States or Euro area that are slumping in a faster pace. Euro area in this juxtaposition is the biggest lagger. That's why the Euro area is in the biggest troubles of this environment. So right now we can find that dragged down by historically high inflation, low consumer confidence, and declining share price indices, the CLIs remain below trend and continue to anticipate a loss of growth momentum in most large economies. So looking at the Europe that we have found that has biggest problems, there is even more problems to come as the rivers of Europe due to the heat wave is right now that's the common phenomenon that are wavering. The cost of transporting gas oil to Basel in Switzerland has surged. Also in Germany, these problems are appearing, whereas we have problems with putting these deliveries on railways. Railways capacities are not sufficient to compensate for missing barges, and right now we may find that putting these supplies on road are also the one that are showing that prices of them will significantly get more expensive. So that's also the map where we may find where we have bigger problems. Coal-fired power plants, steelmakers and other industries in the Ruhr in Germany rely on the Rhine and from receiving raw materials. So within this Rhine river that may get wavering with this heat waves that is just flowing throughout the Europe, we may find that energy crisis may get even worse for the country. US productivity recently has dropped. We are starting out from some of the news that may impact the economy to go a bit more downturn from here. So non-farm productivity recently that was measuring hourly output per worker fall at a 2.5% related to where we were back a year ago. So we can find that also the Department of US said that productivity fell the steepest pace since 1948, and that's exactly the chart showcasing this, and that's something that we need to take into consideration and the Fed should take a consideration on that we cannot really sacrifice the economy in the name of hiking interest rates. That's why they should maybe put their foot off the pedal in the months to come. So especially as it's already a broadest tightening cycle in history. So percent of world's central banks hiking rates right now are the biggest by far. So there are many and many central banks that have joined this cycle of hiking interest rates in tandem. Right, inversion depends, and that already been discussed. We can find that with this one to happen, inversion is just a warning to Fed to proceed more carefully. Right now, the one very important element that may bring us back to a possibility of soft landing is that the Fed will respond to that bond signal. Current inflation data obviously right now is poking this curve and steepening this, but if we just manage to stop the inflation, this spooky looking curve may get a little bit less curvy. In terms of also the time where we may consider that it's already too late to lose interest rates as we are still hiking, we still have a threat of turning up on the market more zombie companies. These are the zombies that are just operating on the fumes of easily redistributed by government money. So by 2021, we already in the US have had a 10% of public companies that has been noted as a zombie companies, and the Fed definitely is creating an environment where zombification is possible, especially with low interest rates that are right at the lower zeros levels. Creditors are encouraged to renew financing to unproductive companies, and we can find that in that time when rates are low and interest payments pose no threat, there's more such companies as that. We don't wanna repeat of the Japanese scenario where the percentage of zombie companies is biggest in the world. By 2020 it was 11.3, and after this losing fiscal policy after pandemic times, this percentage have probably increased even more. So I'm aiming to this, that we shouldn't really take a kind of a very doubtful measures and decisions in order to lower interest rate hikes, interest rates to too much level. Better take it steps at earlier, well, or there might be too late then. So that's already the topic of economy view, and there is a regime change that we already gone through a recent decade. In 2010s, there were more noticed on the market. Wall Street names more inequality, whereas right now we are heading into Main Street, whereas retail traders are taking some of the lead, and inequality is being changed into inclusion. Whereas quantitative easing is turning to quantitative tightening, repression to volatility, deregulation into interventionism, globalization into isolationism, and so on, so forth. And I'm showing you that to really find out that I wouldn't really point out one person that should really find out that in just one decade from 2010s, those transitions may change in that kind of a contrasting way. That's why we may find that we should really adjust to the regimes to be changed. This time is heading faster. Even with this inflationary period may get ended, there is still more change for the economy to come in the next years, especially with this technology transitions people into another environment even faster. So that's annual change in US online prices. That's already pointing positive tendency into deflationary time. However, this regime change also coincide with business that right now laying off more workers, however hiring more specialists. So with this regime changed, with this pandemic going away, we can find that the businesses need to revert the approach to how the business works. That's why we need more and more swaps in a labor markets. That's why we have laid off, but right after this recovered this market, and that's also showcasing that these times of everything being stagnant already away, at least for now. But I guess we are speeding up as a civilization even further in growth development, and that's why I do find that the only one unchanged factor will be the change. That's why the adjustment is the only way to get it through. What we got here is that we are all scratching our heads. US labor market paradox. That's already what justified my point of view. Right here we have inflation surprises are bad, even they are good, and that also stems to the fact that fewer small businesses right now are reporting plans to raise prices. We have recently such a problems with 4 in 10 US small businesses plan to raise prices by at least 10%. Right now, less and less are getting to go through this. That's why manufacturers are paying low prices for the inputs. On the other hand, wages remain well above. So everything stems to the scenario where we may get this inflation eventually, but with more efforts from entrepreneurs. In terms of economy view, that's everything. So let's now jump to market outlook, and on market outlook we can find it let's get to trading view, and on major indexes we are right now continuing at this march to the north, and we can find that the volume right now that is appearing right here is the one that is showing that this rally may not stop right now. So US 100 already is going past this trend line, and I will tell a bit more about it later. Right, so we have here S&P 500 operating EPS growth. Right now we are heading back into the 1% levels, whereas we may find that if you consider that this earnings per share for companies will drop even further, that will mean there is still a room to enter recession doors. Otherwise, I would bet that it's a great point to take some chunk into a stock market from here. So that's another point of view for the chart. Operating earnings per share right now are dropping to 49.3, and that's the correction that some of the stock market investors should take an advantage from. S&P 500 right now, with a juxtaposition of where we're back and during this dot-com bubble in 1998, has shown just merely kind of a growth before a collapse, before a bubble collapse. Right now, in 2020, we have really overlapped that rally from previous 2 decades, and back then we've thought and we've called that period as a bubble. Right now, many of speculators haven't really admitted that there might be a bubble, and we should still rally forward. But with this juxtaposition of 2 charts, there should be no doubts that we already been in such a rally, and the rally we are right now going through might be just a bear rally of a dead cat bounce type that may end up somewhere around the end of a year, with this mid-market election going through the corner. So that was the first part of a more negative news from the market outlook. However, total market cap of stocks right now is rebounding from around $4 trillion and heading back to $800. That's why we can find that there is still a room to grow, at least for now. But in order to get through the record times that there would be a kind of a default for that traditional markets. In S&P 500 earnings, we may find that back in 2020 drop, there was just a tiny slide that has really impacted the valuations to a really small extent. We can really qualify that drop to the bear or recession time, but it was more like a I would say tiny and quick slide that resembles a correction on this extended timeline, rather than a real bear recession that lasted for long. Right here we have the environment that put in favor small cap stocks, and that means that sentiment right now is covering, as well as this chart that is showing that sentiment is rebounding so much. So right now bears this week were down to 27.8% and 44.1% at the extreme point in late June 2022. Right now we are trying to recover, and that's why we have this rally. S&P 500 weekly announced buybacks was almost as high as it was back in 2018 crisis of tightening period, and right now we have just have found that much more cash has been really piled on the sideline than it was back in 2018, with some of a belief that the market would recover by itself, with some retail money just flowing into that correction. So with the sentiment, I would expect 60/40 wallet to eventually make some move, and even with this portfolio suffered recently to that extent that haven't been seen since 1988. Right now we have gone through the tempo that has got 17%, and right now generating losses at the level of 11.5. We still far from the positivity on the market, but that might be a reason why we may get interested in this market right now, if that's not a dead cat bounce, obviously. So right now we have gone through market outlook. Let's get to cryptos. And recently we have discussed that these regulations on private cryptocurrency market is something that may really push the valuations down. However, the market hasn't reacted. As I have also convinced, I found that those regulations shouldn't really have much of an impact on the cryptocurrencies solutions, as those solutions are really favored by many of technologists and users that are just hungry for such ways of exchanging cash in an anonymous manner. So cumulative return of privacy coins recently hasn't suffered, and also Zcash price as well as secret network price are still on a good and this growing tendency. Monero is stopped for a while, but I do find that after the stabilization and those regulation voices been silenced, we'll finally also get some better time for this chain. We could find that the more and more things we can listen and from an industry is that crypto brokers lending fell in previous quarter, right after this wave of bankruptcies. Also, Genesis, that is a subsidiary of Barry Silbert's digital currency group, admitted, but there are more positive sounds right there, as optimism protocol is going through some better time right now. So optimism is this layer 2 Ethereum blockchain that seeks to scale ecosystem via rollups or off-chain computations to speed up transactions. So with this merge coming up on somewhere around 15th and 12th of September, we may find that such solutions should also gain more traction. So Optimism is also the home for 35 protocols, including derivatives exchange, synthetics, decentralized exchange Uniswap, and automated market maker Velodrome. So that's the one of the solutions that are really getting much more of an interest from investors. Right now, however, in terms of this type of chart of crypto total market cap, right now we are really fighting for getting back towards this growth area on a logarithmic chart. With this line being crossed, we may find that there still might be just a dead cat bounce right somewhere around September, right after this Ethereum merge. That's why it's very important how the reaction of the market will be in the second half of September, when there won't be much of a bigger news. Sorry for this. Much of a bigger news on the market yet. So in terms of next, we have market movers that we may find that on Thursday we have, I need to refresh it, yeah, we have PPIs from US that turn out at much lower price right now. That's why producer price inflation is putting in favor that this inflation is eventually may get weaker and weaker in the weeks to come. That's very optimistic gauge been already published. So right here we have on Friday GDP from Great Britain that is worth looking, and also noteworthy is that France inflation rate. So these are the gauges of the week that are really putting more optimism on the markets. So it gives some room for whether it's commodities and cryptos or equities to gain. Recently, we have even found that more optimism been found in this medium cap stocks. The trade desk exploded after earnings season, and that means we may see such of reactions with another companies of medium or even the small caps as well. In terms of earnings growth, we have yesterday Canada Goose that remained better than expected, and tomorrow it's on Friday, and we'll have a broad bridge and Seabridge Gold that is worth watched. In terms of trade idea section, I have for you exactly the one chart that been already one of the most important on the market, is that US 100 chart is showing much of a growth and much of a I would say, solid growth and becoming much of a stallion right after heading past those recent lows and heading the new wave of higher highs, higher lows. That would mean that we are heading back into a growth direction after just getting out of this recessionary zones. For US 100 to take a bet, I would just wait for how the reaction of the market really looks, and right now we have positioning of all clients favoring the sold position, sell positions, as well as position value more to the downside. So we are still on a side of the minority with this move being developed even further. We may get even to the 15,000s area within few months. So right now, every single pullback of US 100, I would just take as a kind of a proposition and a chance to long the US stock market even further. So right now we may find that this line is crossed, and I would wait for another entrance right around 1300s area, with getting around this trend line from the upper side. Right, so that's just the proposition of a trade. If we just manage to get back to those areas, there will be a kind of a decent trade to be made, and that's also something that we may consider as longing from here, from 13,100s to around 14,000s to those highs of March of 2022 that are also of significance. So that's it in today's episode. Thank you very much for watching. If you have any questions, just put it in the comment section below the video, and see you tomorrow.